Guys, thanks so much for joining us tonight. We're fortunate to have a great speaker, Logan Hartle, who has a passion for real estate that began as a young man when he helped his parents with leasing and maintaining their apartment building portfolio. After graduating from West Virginia University with a BS in industrial engineering, very relevant to tonight's topic, Logan launched his career in the manufacturing sector. His 10-year career in manufacturing began with the execution of cost savings initiatives and facilities maintenance programs, and culminated in a 5-year stint as the owner of his own manufacturing company. During this tenure, he was actively involved on the board of directors of the West Virginia Manufacturers Association. Upon selling his manufacturing business in 2020, Logan took his knowledge of industrial buildings and investments to the brokerage world. As a broker, Logan primarily operates as a listing broker for industrial owners and landlords. He is skilled in the marketing, consultation, and facilitation of investment and sale leaseback transactions. He's also the host of the True Commercial Real Estate podcast, where he interviews high-level investors on various commercial real estate topics. So without further ado, Logan, I turn it over to you.
Let me unmute there. Awesome. Well, I appreciate that introduction. Yeah, thank you so much. Thanks everybody for having me here. Yeah, this is exciting. I'm excited to share my knowledge. Hopefully I'm not one of the 6 reasons you want your money back at the end of this year if you are new, so I apologize if you are. So I'm going to share some slides with you, but yeah, just to kind of reiterate what Charles said. Yeah, I'm a licensed real estate broker here in Charlotte. And I transact in the North and South Carolina markets in the industrial investment space. So I don't know if does anybody on the call own any industrial real estate at the moment or ever looked at anything? Just a question to start with. No? Right. Then I can tell you whatever and you guys are just going to believe it because if you don't know that. No, I'm just kidding. So I'm going to share my screen. And so I am looking. Okay, great. Yeah, it's an awesome market. It's a growing market. I'll get into a little bit of the stats and the things that are going on in the marketplace. But yeah, without further ado, I'm going to share my screen with you all just so we can jump into this presentation. So are you all seeing this? Is everybody seeing my screen right now? Okay, yep. I'm not going to go into full presenter mode on this PowerPoint presentation. I hope that doesn't bother anybody. Just because when I do it, it takes up both of my screens and I lose seeing everybody here. So if it's all right with you, I'm just going to keep it like this. So we're going to go over the basics since you guys are probably mostly unfamiliar with the industrial space. So we're going to talk a little bit about everything. So this is kind of what we're going to run into. What is industrial? We'll go through a little bit of the terminology. We'll go through who's a typical buyer for an industrial space. What do industrial leases look like? They're a lot different, obviously, than residential or multifamily leases. What makes a good deal and how to find a good deal. We can go into a little bit about that, and we'll talk a little bit about the stats and whatnot. And then at the end, I'll give you guys a chance to ask any questions you might like, just so we can answer everything you might have questions about. So just jumping right in. So what constitutes industrial? Most people think of industrial and they think, an old warehouse building or a manufacturing building. They think of steel being poured and just nasty nitty gritty stuff. But the industrial space actually spans quite a breadth of different types of properties. So the next 2 slides, I'm gonna hit on a few different types of property for industrial. So one of those that kind of hits home most with the multifamily group and most with the residential investment groups is this concept called flex. And flex space is essentially, a lot of flex buildings are multi-tenant industrial spaces where you have a certain portion that is office and a certain portion that is warehouse. And they're flexible because typically you can add a little bit more walls to increase your office space or reduce them to increase your warehouse space. So it's a combination of warehouse and office, usually on a much smaller scale than what you'd see in a big manufacturing or a big distribution facility. So the picture in the top left is a typical flex space. You'll see on the fronts or backs of these buildings, there will be dock doors or drive-up doors, garage style doors, and there will be office space, but they tend to be multi-tenant facilities. Distribution is just in general covers a very large gamut of the industrial space. This is what's getting the headlines now in the industrial space. If you all have heard of what's happening and you're driving up and down the interstates and you're seeing these big boxes go up, primarily that's for distribution. So distribution, think everything from People bringing in large pallets of product that they're just storing for a little while. That's more warehousing, and then they're going to ship that pallet out. Or third-party logistics like Amazon, they're going to take that pallet, they're going to break it apart, and they're actually going to do fulfillment where someone places an order and it's actually shipping from that warehouse to your actual residence. It's going to come out of a facility that looks something like this. So that's distribution. That's where the vast majority of this big industrial growth has happened recently. And manufacturing, everybody's probably somewhat familiar with manufacturers. They make stuff, right? They're making the things we have. A few stats I want to share with you guys. Like as you're driving up and down the highway and you're seeing these giant things built, I mean, it's unbelievable how much inventory of industrial is being built right now. CBRE did a study that showed that for every $1 billion of e-commerce growth, there's 1.25 million square feet of industrial distribution space needed. So in 2021, there was about 870 billion nationwide in e-commerce. And last year in 2022, it was over $1 trillion, which was $170 billion of growth, which means which equates to roughly 212 million square feet of industrial. Just so to put that in perspective, a 1 million square foot industrial building is like the biggest of the biggest buildings that a lot of these developers are building. So just in that e-commerce growth alone, 212 of those were needed across the United States to be built. These are massive developments. So that's why you're seeing all this massive growth across the country in this space. And as you're driving up and down highways, you're seeing these big giant boxes go up. Is everybody still seeing this okay? Are we good still? Just want to make sure I don't get too far down the road. Okay. Manufacturing is growing as well. I was actually at a manufacturing conference about a month ago, and the North Carolina Economic Development Partnership, that one of the heads of the Economic Development Partnership was there and mentioned that there are 240 new projects looking to come to North Carolina that equate to around 89,000 jobs and over $103 billion in capital expenditure. So when you look at the massive scale of industrial and this growth in this market, it's easy to see why people are getting excited about it, right? It's no longer just this, a couple of small metal buildings that, or even large metal buildings that's just kind of dirty and nasty. It's modern technology coming here in these very large companies. About a sixth of those were automotive that are looking to move here. And I know that's kind of top level, top scale. None of us are probably going to be buying an Amazon building, but there's a trickle down effect, right? And what that is as these companies start to come here, there's more and more of a need for smaller multi-tenant, smaller flex for contractors that are servicing those companies, for groups that are actually going to show up to do work inside of those buildings. And those are typically the ones that the smaller investors can take advantage of in getting those types of tenants. So moving on to the next page here, that was kind of a mouthful, so sorry for that. So three other typical areas of industrial, or three other types of industrial: storage. In a lot of areas, self-storage is actually in a lot of areas is designated or zoned industrial, but there's other types of storage, just dry storage, various different things that are constituted as industrial. Lay down space for materials, trucks, equipment, what have you, that tends to be zoned industrial or heavy industrial. And then specialty, think, concrete, you see concrete equipment plants, or you see any sort of lumber mill or anything like that are these really weird specialty types of things, are also typically constituted as industrial. So that kind of runs the gamut and just gives you a top level overview, just to show that it's not just these boxes, right? There's a lot going on in the industrial space. So sorry if this is all very textbook like. I promise we're going to get to some of the nitty gritty details, but I think it's important just to give you guys an overview if you're not familiar with it. So some of the terminology you'll run into, if you're used to multifamily, you're going to look at things in units, right? So in industrial, we measure an area. So usually, it's 100,000 square feet or 10,000 square feet. That's usually what you're going to hear when you're measuring in industrial. You'll hear, office to warehouse ratio. You'll see a lot of that, if you're looking out there and you're looking at offering memorandums that brokers have put out, or if you're talking to different buyers, you might see those different metrics. You'll see something called clear height. Clear height's an important metric because it basically measures what you can put in that building. And it's basically measured as the measurement from the base floor that you have to the lowest hanging object, right? So if you need to be able to drive machinery through a facility, or you need to be able to stack racking really high, how high can you go, basically, is what you're trying to look for in clear height. And they're important metrics. These I'm hitting the top level metrics for industrial that most groups are going to want to understand. And these are important if you are getting into industrial, to know who your tenant base is and what they need. Column spacing. Column spacing is another thing you'll probably see on offering memorandums if you're out there looking at industrial, and it basically is exactly that. It's the distance between columns. This one looks like this is an older facility, but you'll see the measurement between those columns, and that's important again for machinery and spatial layout. You want to make sure that you've got something with as wide a breadth as possible, so you can accommodate as many different possible tenants in that building. Dock doors and drive-in doors. These on the left-hand side are dock doors. So this is pretty standard. What a 18-wheeler is going to back up to. So these little red things here are actually dock levelers. So the 18-wheeler will back up, that'll lift up and will drop down on the back of that trailer, so they can drive forklifts in and out. These are, you'll see these referred to as drive-in doors or grade level doors, bay doors. Essentially, they're garage doors. They're doors that you can drive vans in if you need to drive directly into the building. Typically, this is how they'll get machinery and other products in and out, and this is how they're going to transport materials in and out of these facilities. Lay down space is a big thing for each of these. We mentioned that a little bit. Again, lay down is outdoor storage for vehicles, equipment, raw materials, etc. So one more terminology here for you for these. Apron space. Apron space is the distance between the building and the nearest object over here that trucks have. It's a distance trucks have to maneuver in around, and your standard now is about 120 feet plus. So more modern buildings are getting 140, 150, and basically what that is the more space you have there, the easier it is for trucks to maneuver, which means typically they can get those dock doors closer and closer and closer together, because they want, big distribution, they want to have as many possible dock doors as possible. Because if you only have 4, as is in this picture, and there's 10 trucks waiting, obviously they have to wait. If you've had 20, all of those can get in and out much, much faster. So that's just some general terminology. And I know that's the boring part of this is just kind of getting to know some general terms, but it is important to understand what you need to be looking at. If you are looking at industrial buildings, to start with, understand them, what's important to those tenants, because really it all comes down to that. Much like in the residential space, tenants are going to, maybe if you're single family, maybe they want to know if there's a fenced backyard. They want to know if the kitchen's been redone. They want to know all the nice things about the house or the unit. If you're in the apartment world, they want to know all the amenities that come along with it. Industrial is the same way. The tenants are going to want to know what those amenities are, and all of the things we went through, ceiling heights and how much truck space they have. Is there any lay down space? Those are all additional amenities that are going to really attract good quality tenants to an industrial property. So now we're going to jump a little bit into who buys industrial. So this is interesting because in the residential space, it's primarily going to be, if you're single family housing, you're competing against an end user, which is the homeowner, or you're competing against other investors. In the multifamily space, you're typically not competing against end users, because someone typically doesn't buy a 50-unit apartment building just to live in it, right? They don't often do that. Maybe in the house hacking on the smaller side of that, 2, 3, 4 units. But in the industrial space and commercial in general, oftentimes you're competing against end users as well. So who buys industrial? This is a CoStar breakdown of the last 5 years in the Charlotte market and who has actually purchased industrial space. So 44% was private, 6% was REITs, real estate investment trusts. I don't know if you guys are familiar with those. They're public entities that have stock and issue stock. 11% private equity. So those are groups that have raised funds, either syndicated or raised funds. Institutional, we'll jump into that in the next slide, but they're kind of lump them in the same category as REITs, but they're very, very large institutional players. And then users, like we said, their users will utilize these spaces as well. Institutional. So again, pension funds, insurance companies, REITs, large private equity groups, these very, very large, these are groups that have raised or have, billions or trillions of dollars. And these are typically the ones who are going after and buying large Amazon distribution centers, the $100 million, $200 million, $300 million transactions. Those are typically who are going to go after those. They're very low cap rates. You'll see 3.5%, 4.5% cap rates, 20-year leases on these things that are brand new builds. And it's basically for a pension fund or an insurance company. It's not necessarily as much about how much, what's my upside, what's my value add. It's how do I not lose money? Like I need this money to be safe as can be, and how do I not lose money? And so that's the type of assets they're looking for. From the private equity and syndication model, you guys are probably somewhat familiar with that. Private equity funds, they've raised money up in advance for their investment thesis, and they're going out to place that capital. Syndicators are raising funds maybe for a specific asset. They're going around, they're passing the hat around, hey, we've got this asset, and they're selling it to their investors. Let's go take down this asset. So those groups also buy industrial as well, just like they do in the multifamily side of things. End users, as we discussed, so manufacturers are end users, service businesses, warehouse and distribution, environmental companies, government entities. These are all users of industrial space. So all these groups are utilizing this type of space. Private investors, and then this is the private category. This is kind of where all of us come in, unless somebody here runs a REIT that I don't know of. This is kind of where the rest of us fit, which are private LLCs, or mom and pop wealthy individuals, or just investors grinding trying to buy assets. So these are probably my favorite to work with, just because it's this group. It's people who are trying to make a living and trying to build their wealth. So that is, it's not just Amazon box stores. There's a lot to be done in this space for private investors as well. Industrial leasing. So I know I'm going like 100 miles a minute. So if I can stop for a second, if anybody wants to ask a question about anything we've talked about so far. I know you said let's save questions for the end. Charles, would you rather wait to the end, or do you want me to open it up now and let people ask questions about what I've talked about so far?
Logan, I'll actually leave that up to you. It's speaker's discretion. What would you prefer?
Yeah, you guys can do so. Maybe what we'll do is I'll let anybody ask any questions they want right now for what we've done, and then we'll go section by section. If you have any questions about that, we can hit that before we move on. So, does anybody have any questions so far about what we've gone over? I know it's a lot of education and interested in the land and triads. Oh, sorry, this was earlier.
So guys, one quick note just to kind of piggyback on what Logan's saying. So last week I was at a private equity event in New York, and there was a lot of different things people were talking about. But in terms of real estate, the only one that actually came up was sale leasebacks, which is one of the things Logan's talking about tonight. So I realize this may be a new concept to many of you. If you have questions, feel free to ask. Logan's an expert, and he certainly has a lot of knowledge and wisdom to share on it.
Absolutely. Thank you. Yeah, and I'll definitely jump into that for sure. I'll hit that in the very next section here. We're going to talk about leasing, and I can piggyback right into that and just kind of talk a little bit about the leases. Does anybody have a question specifically regarding that? All right, well, I'll hop in and we'll just go through. So if you're used to residential leases and you're used to, 1-year leases and the landlord pays for everything, you're probably going to love commercial leasing. That's like one of the reasons that people transition out of the residential space into the commercial world is they get tired of having to fix toilets and pay the taxes and the insurance and handle everything. In the industrial space and in a lot of different commercial space, the tenants got a lot more responsibility than they do in the residential space. So some key terms just in leases, obviously, just like in the residential space, you want to know what the lease length is. In the residential world, you typically have 1-year leases, right? They're rolling over every year, or maybe you have month to month, maybe you have 6 months, but you might have a little bit longer. Lease terms can vary dramatically in the industrial space. You may have some of those smaller flex spaces that are 1, 2, 3-year leases. You may have 5-year or 10-year leases. Some of the larger spaces, sale leasebacks, as Charles said, most of the sale leasebacks we're looking at are 15-year leases. So these are long-term leases where you're not having to worry about rolling over a tenant. And there's goods and bads of that, and we can jump into that. Typically, a base rate, it's $1 per square foot per year. So theoretically, if it's a 100,000 square foot building and you're paying $10 a square foot a year, that's going to come out to 100,000 times 10 is $1 million they're going to pay annually. So that's some markets do that on a monthly basis. Charlotte here, we tend to refer that as $1 per square foot per year on a base rate basis. Escalations. Most leases have built-in escalations. So it's not like at the end of the turnover of the lease, you're going back to your tenant every year and saying, hey, rents went up, we got to raise this. Most of them have pre-baked in escalations, somewhere 2%, 3%, 4% every single year that's automatically baked into that lease. TICAM, that is a term for taxes, insurance, and common area maintenance. So in most of these leases, if they're what we're called triple net leases. So a triple net lease means that the tenant is responsible for all of the nets, the taxes, the insurance, and the common area maintenance. So it's not uncommon for one of these for the tenant to either reimburse the landlord for all of those expenses or just pay those out of pocket as they come in. TI is tenant improvement, and that happens at the beginning of a lease where a tenant's going to move in, and sometimes the landlord will kick in a little bit of that. Unlike in a residential space where you get the unit ready and then a tenant moves in, oftentimes you have the basics there. The lights are on, you've got a shell, or you've got the walls are painted, and that's about it. But a tenant might need additional electrical. A tenant might need to change, the flooring. They may have to add a foundation in under a piece of machinery. And the tenant says, okay, this is going to cost me $100,000 to move my business into this space. And oftentimes the landlord will contribute to that if the tenant's willing to sign a long enough lease. So tenant improvements are definitely something that's going to come up in the lease as well. So most leases are going to have some sort of language surrounding at least these 5 things. How long is it going to be? What's the base rent? What are the escalations? Who's paying what in terms of the taxes, insurance, common area maintenance, and then tenant improvements as well. Who's going to pay for that? So as far as lease terms, triple net, I mentioned the word triple net. If you're not familiar with that, it's exactly that. Absolute triple net is like the most hands-off you can be. In an absolute triple net, the tenant literally handles everything. The landlord gets a check and pays their mortgage if they have a mortgage. If they don't have a mortgage, they get their check, and that's it. The tenant is responsible for taxes, insurance, all the maintenance. If the roof goes bad, the tenant is responsible for the roof, everything, literally everything. It's kind of weird. People, if you're not familiar with that, like why would a tenant ever sign up for that? That's crazy. But in reality, a lot of times, if the landlord is investing a lot into that tenant, and if the landlord is giving that tenant a 20-year lease, right? The landlord is basically saying, I'm not going to give this to anybody else. And if I'm giving you a 2 or 3% escalation every year in your rent and market rate goes up 10% or 20%, 30%, I'm stuck here. And if the taxes go up accordingly based on, your operation and the insurance goes up based on your operation, you're going to have to handle that. And so the trade-off there for the tenant is they know what their long-term liability is going to be for that lease. And they know that it's not going to fluctuate with the market and potentially take off on them. So they can budget and they can prepare for that. So a lot of times they're willing to do that. Triple net, typically in triple net, the landlord handles the roof and structure. You'll see that a lot in leases where tenants are still responsible for their portion. If it's a multi-tenant building and you have 10% of it, you may be responsible for 10% of the insurance, 10% of the taxes, and 10% of the common area maintenance. And then and also maintenance inside your building. Typically that means the tenants are taking care of the plumbing, they're taking care of any lights that go bad, they're taking care of, the electrical system inside their building, but the landlord would still be in charge of roof and structure if something happened structurally or the roof went bad. Gross leases and modified gross leases. Gross leases tend to be, you're paying your lease and that's it. You're handling your taxes and insurance. The landlord's still paying taxes, insurance, common area maintenance. And then modified gross can be a combination of that. Sometimes they'll negotiate and they'll say, okay, the tenant will handle the insurance, landlord's handling the taxes. Tenant will handle the common area maintenance, landlord's handling this. And those are negotiable and part of this. And as you're negotiating those leases, different things can happen. Those tend to be modified gross. And then full service is literally everything. Landlord might handle taxes, insurance, utilities, everything. And that's a little bit more common to a little bit more like the residential world, if you will. So that's what a full service lease would be in this space. Any questions on that and the leasing structures like that before we move on? All right. All right. So yeah, the type of lease again tends to be asset dependent. So large class A manufacturing and distribution, single tenant and national tenant. These tend to be long leases. I see a hand up. Yeah, go ahead.
Just curious, triple N, what is the N for?
Those are nets. So triple nets, net. So net of taxes, net of insurance, net of maintenance. So it's just a term
Okay.
we use in the space to say, the tenant's basically paying for everything. Yeah.
Okay, thank you.
Welcome. So yeah, the single tenant, big, large, Manufacturing and distribution areas we see a little bit, they tend to be longer leases. So 10-year plus, it's not uncommon to do a 15 or 20-year lease, not uncommon. Triple net or absolute triple net. If it's a multi-location business, this is another nice thing about the commercial space is there typically is a guarantee. So if Amazon is leasing a building, just to say they're going to guarantee that on a corporate lease, which means if for some reason that location suffers, the rest of them are chipping in to pay you still as a landlord. So when you sign that lease and there's a corporate guarantee with a strong corporation, you're getting your money for the next 10 years, 15 years, 20 years. So that's why a lot of the big institutions like these types of deals. You still do that on these smaller properties, like Class B and C properties or smaller properties. You can still get guarantees. They tend to be 3 to 10-year leases. This is where you see a little bit more gross, but you still see, double net, triple net, or absolute triple net. You can still see those in Class B and C properties, more B than C, but multi-location companies or even regional businesses tend to locate in a lot of these. And if they are big enough and they have a strong enough credit for their company, sometimes you can get away with a corporate guarantee as well. If they're a single location or maybe they don't have enough credit, oftentimes you can get the owner of that business to sign a personal guarantee on those leases as well. So, if it's a business that's, it makes $100,000 a year and it's going to pay you 50, 60,000 in a lease, it's like, hey, that's a whole lot of your income. I'm not sure this is going to really fly. But if you've got an owner of that business who's got $10 million in the bank and they're willing to sign a personal guarantee, makes it a lot safer for you as the landlord to go ahead and sign that and get the person themselves, the owner themselves, to sign that personal guarantee. So we see both of those in the industrial space. Multi-tenant flex properties, they can be longer term leases, but typically you're seeing those 2 to 3 year, anywhere from 1 to 5, but typically 2 to 3 year leases. They tend to be a reimbursement structure, that TICAM, if you will. So what will happen in those is you'll have a base rate. The tenant will come in and they'll take 2,000 square feet and they'll lease it at $10 a square foot. So they're going to pay you $20,000 across the year. You're also charging them, let's say it's $2 that you estimate for taxes, insurance, and common area maintenance. It's $2 a square foot as well that you're charging them on that same 2,000 square feet. So that's $4,000 for the year. At the end of the year, if it came out to $6,000, the landlord's typically back billing them for the additional $2,000. And if it comes out to only $2,000, maybe you're giving them a reimbursement for the $2,000 they've already paid you. But that's what that TICAM is. So if you're looking on the market and you see base rate plus TICAM, you'll see it as like that. You'll see $10 a square foot plus $2 in TICAM fees. And that's what that TICAM is: taxes, insurance, and common area maintenance that the tenant is going to contribute for being in that property. The sale leaseback is something that's really, really interesting. We'll jump into this in a second, but the sale leaseback is a unique concept where the owner of a building operates a business out of that building and owns that business. So if it's a business that owns its own real estate, what they'll do sometimes is they will be willing to sell that real estate and then lease it back from that investor at closing. So you're negotiating both a sale and a lease as part of this deal. And it seems kind of weird, right? If you own your building, why would you ever sell it and become a tenant? And from the investor standpoint, a property investor standpoint, that just seems weird. It seems wild. Like when I first heard about these, I was like, no one would ever do that. Why would they ever do that? But when you think about these actual businesses themselves, it starts to make a lot of sense depending on their company, right? There's companies who, if you're a manufacturing company and you're in a building that's worth $10 million. And you've put $50 million worth of equipment in that building. And you know that if I sold my building for $10 million and I reinvested that $10 million back into a new product line, I'm going to make, $4 million a year on that product line in net profit. My lease rate is going to be, $1 million a year, but I'm going to make $4 million if I reinvest that money. It makes total sense for you to get out of that building and reinvest that capital back in. And I know those are huge numbers, and these happen on smaller scales as well. So, I've seen sale leasebacks in, $1 million range, $1.5 million, $2 million range. So it doesn't have to be a very large building like that. But essentially what it comes down to is the seller of that the owner of that business knows that the equity that's in their building is better put to use inside their business than it is by owning that real estate. Oftentimes they can eliminate all their debt. Like if they own a $2 million building and they've got $500,000 in debt and $500,000 on a line of credit, they can clear out their debt. So their balance sheet looks a lot better. Instead of having, all of that debt on their books, they now have $1 million in cash and no debt. Now their balance sheet looks a lot better. You see this a lot with big private equity companies that are coming in and buying up other companies. They'll come in and they'll buy up the company, that company owns the real estate as well, and then they'll sell off the real estate on the back end, because their hope is to accumulate companies and they don't want to be a real estate holder. You'll see it on a smaller scale, like I said, with other companies that are just smaller businesses that can reinvest that capital back into their actual business. So it's a unique model that if you in the investment space, it can happen on a very small scale. If you find a local dentist who owns his own real estate, you can do a sale leaseback. If you find somebody who has a small retail outlet and they have one of the locations they actually run a business out of, as long as they own the building and the business inside of there, you can do a sale leaseback transaction. And oftentimes it makes the bank a little more comfortable because you've got a group that's been there for a while. They may be operating out of that site for the last 20 years. So, or 10 years, 5 years, whatever it is, you can go to the bank and say, hey, as part of this, here's the company, here's their financials, here's how long they've been operating in this space. I'm going to have a tenant built in from day one. They're willing to sign a 10-year lease whenever I go to bat here and I go to try to take down this transaction. Makes the bank a lot more comfortable as well. So it can be a really, really great win-win for everybody. It's not for everybody. Not every business wants to do that, but it can be a really great transaction for all parties, especially if you're just getting into the industrial space or commercial space in general, and you want to be pretty secure that you're going to have a tenant for a long term. You don't want to buy something vacant and think, I don't know how to handle this in general. This is my first commercial property. It can be a good way to do it. Before we jump into the different types of assets and deals, any questions on that? Any questions on leases and in the commercial space in general? All right, either I am explaining this really well or I've put everyone to sleep.
I think you're explaining it really well.
Good. I hope so. All right. So what constitutes a good deal? That's going to be kind of dependent. We walked through earlier the different types of people that buy these properties, and those different types of people are going to have different criteria, right? So a small investor's criteria for a good deal versus a institution are going to have different deals. So we break this down into four real categories, and this can really be for anything. This applies to the multifamily space. This applies to the medical office space. This applies to the industrial space. And it's core plus, value add, and opportunistic. So core tend to be those big Class A stuff we talked about, long-term leases, big tenants, large money, think Amazon, FedEx, very, very small cap rates, stable. That's core. Core plus would be that plus some upside, right? Like, let's say there's 10 years left on a lease, and there's escalations that you think are higher than normal. That could be a good deal for core plus. It could be a core deal that's got some extra land that they think they can sell off, and it's just going to increase their IRR or increase their return metrics. But it's that core deal. It's still got all the same concept of, we've got a long-term, really good tenant. We're going to pay a pretty penny for it, but there's a little bit more upside than just waiting for those escalations. In core and core plus deals, most of the upside on those is groups are going to wait on those escalations. They want that steady cash flow, and every year it's going up 2%, 3%, 4%, whatever that is. The value add is really where most smaller investors, the value add and opportunistic are really where most smaller investors want to focus. And it's because most of us don't have 10, 20, $100 million of cash that we're just trying to create a safe space for somewhere. If you do have 100 million in cash, let's go have lunch tomorrow. I've got some buildings for you. But yeah, so this is where most groups want to be. And a lot of these, it's a unique market. The value add in the industrial space is an interesting one. You can get a value add. You can add value to a property in a lot of different ways. It's all much like the multifamily space. It typically is all based on net operating income. So if you guys have been in part of other meetups where you're talking about, how are we evaluating a multifamily space, and it's cap rates and net operating income, you're bringing in all your rental income, all your landlord expenses, and what's left is your net operating income before you get to your mortgage. It's just what's left over there. You divide that by a cap rate, it comes up with a price, right? So it, much like in the multifamily space, you're trying to increase that net operating income. So that can be done in a multitude of ways. It can be done by one of the more common ways, and one of the things that most investors are asking for right now is, find me something that had a 10-year tenant and they've got 2 years left on the lease. And the reason they want that is the market has gone significantly up in rental rates over the last 10 years. In the last 5 years, it's been 10 to 15% year over year growth in these rental rates. Meanwhile, those tenants, like we said, are locked into a 2 or 3 year 2 or 3% escalation. So you may have a tenant that is paying $4 a square foot right now. Next year, they're going to pay $4.10. The year after that, they're going to pay $4.25. Well, the market for that building is already at $7. So if that's a 100,000 square foot building, there's a $3 per square foot delta on that potential NOI, which means if you roll that tenant over in 3 years from now, you've just added $300,000 in net operating income. So, that can be many, many millions of dollars on a larger property like that, or even several $100,000 on a smaller property. So that's one value add that we're seeing a lot of investors go after for these industrial spaces, are those places where there's 2 to 3 years left on a long-term lease. If this is a flex building, much like regular multifamily, where you've got shorter term leases, sometimes you find value there. Sometimes, that the landlord is just, they're tired. They've had this property forever. They don't want to fight with tenants. So they've got their leases at $7 or $8 a foot, and they're turning over every year or two. Those tenants just keep signing a 1 year lease, and the market's got to $10, $12, $13 a foot. So investors can sometimes find those. They tend to be more off market deals. It tends to be mom and pop in that specific scenario. But you can find those every once in a while where you've got just there's not a long-term tenant. So in the multifamily space, it's great because every year you're rolling those leases over, right? So if you're leasing something at $1,000 a month, and the market turns, and next year you're at 1,100, and the next year you're at 1,300, that's where a lot of multifamily players are making their money. Charles, you can tell me if I'm wrong. That's what happened. You guys are rolling the leases over, you're fixing up the places. It's a very, very similar thing in the industrial space, just a little bit longer lease terms typically. So those are kind of the value adds that you'll see is they like, a lot of the value add investors want something that's got some cash flow already, but maybe it's under market with the leases, or maybe it's partially vacant and it's, hey, we're at market, but it's only 70 or 80% occupied, and we think we can lease up the other 20%. And that's going to be our value add. So those are kind of two ways you'll see value add investors go about the market and take down value add projects. Opportunistic, these tend to be the highest risk properties. They can be vacant or have extremely high vacancy. They have the highest potential upside though. I'm working with a client that we just sold a property for. He bought it for $1 million, I think 4 years ago, and we sold it for $4.5 million. And he bought it and fixed it up, and he did nice work with fixing it up. But I mean, it was a couple $100,000, and then leased it up, and that lease up is what got him that extra delta. So just this is where the most risk comes in, because you're buying a vacant building and you're footing the bill for all that. And if it stays vacant for 12 months, you're paying your mortgage, taxes, insurance, all that fun stuff. So typically these, you've got to either come in with cash, come in with hard money, come in with some sort of money. This is kind of like your flip, right? This is kind of like you're going in with the property that's nasty. The bank won't loan on it. Nobody wants to touch this. So you're going to go in with hard money or cash and fix this thing up, get it leased out. But much like a really, really good flip, this is where a lot of the juice is, right? There's a lot of potential upside in these types of deals. So, but it's important when you're looking at these deals, there's a lot of deals out there that are vacant buildings that you can look at, that if they don't have the key things we talked about, maybe they don't have good enough clearance and clear height, maybe they don't have any truck court, it's too tight, and the boundaries around the property aren't wide enough where you can even get a truck around, or any number of things that a tenant's not going to want. You can also have a whole lot of risk there by not knowing what you're getting into. So that's where working with a really good broker can come in handy to tell you, hey, this could lease out for X, Y, and Z, or hey, be really conservative here because here are some issues with this property. So that's kind of the rundown of the 4 different types of investment strategies we see in the industrial space. Does anybody have any questions about any of that? All righty. How to find deals. So much like every other much like every other real estate category that's out there, we find deals in very, very similar ways. So we find it through networking. We find it through marketing. So we do a lot of direct mail. We do a lot of cold calling. You can use services in the commercial space. There's a service called Reonomy, which is, it's when you're looking at it, it kind of looks like if you've ever been on a GIS and you can see parcels outlined, but when you click on those parcels, it comes up with the ownership information, contact information, all that fun stuff. It's that for the commercial side of things. I think Prospect now has something for the residential side and commercial side. I think is one of the brands there, but CoStar, Crexy, I've found potential deals on Craigslist using the GIS. So utilizing those services to find ownership information and just old school prospecting is one of the greatest ways. Brokers, if you can build really good brokerage relationships, brokers can bring you off market deals. There's a huge volume of commercial deals that get done off market, just because people have good relationships, and a seller will call and say, hey, look, I don't want to list this thing, but if you know anybody that can give me an offer, I'll entertain offers. And then, you go out to your group, so we're buying, and you say, hey, I got this guy, he wants to sell. If the offer's right, and it never hits the market. I mean, that happens all the time. So if you're looking at getting into this game, make really good connections with brokers. And then obviously you can find them online. The online resources in the commercial side are Crexy, CoStar, LoopNet, Commercial Exchange is another one. So you can find some deals on those sites. And if you're just starting out, I would highly recommend that. Spend time just looking through what's out there on the market. Look at how brokers are positioning these things. Look at how what the lease rates are on these properties, and just spend time digging into that market. And eventually you'll find a niche. You'll find it, whatever your niche is that you want to hit in this market, whether it's flex spaces or big warehouses or whatever that might be. You can find a niche and really exploit that niche. So
Hey, Logan.
Yeah, go ahead.
I'm sorry, I missed it. There are actually a couple of questions in the chat here.
Oh, all right.
So Antoine is saying he's interested in flex property for event space. Are there wholesalers in this space? And how are you evaluating the properties?
Yeah, so there are wholesalers in this space. As a broker, I don't have a whole lot of communication with them. Usually they're talking to the same people I am, right? So they're going to go after.
Right, that's right.
Well, so, but yeah, there are, and I think there are far fewer wholesalers in the commercial space. Probably just because of the size of the transactions, right? Talking to a lot of these, a lot of the owners of these properties tend to be pretty sophisticated people, and not that homeowners aren't, but they tend to know, hey, my property's worth this. I know what it's worth. Here's what's going on. And it's tough sometimes to get that done. Not that there aren't deals to be found out there.
Naturally, that lends itself less to a wholesale deal. Okay, so he had two more questions. How are you evaluating the properties? And are there certain things you cannot do in a flex space depending on the typical zoning?
Yeah, so I'll answer the zoning one first because it's a shorter one, and then the evaluation one I'll get to because that one's going to depend. But so from a zoning perspective, it's really going to be depending on where you're buying. So typically, if you contact the planning and zoning department inside of your that whatever area you're in, they'll be able to tell you a list of accepted uses based on the zoning that you're dealing with. So look up whoever planning and zoning is. And if it's, you look at a building and it says I-1, call them up and say, hey, do you have a list? Typically what they'll have is they'll have some sort of chart that says it lists every possible business you could think of. And then across the top, it'll say I-1, I-2, I-3, and there'll be check boxes, yes or no, whether you can actually do that. If it's something that's not on there, then they'll be able to give you some guidance, so on and so forth. So I think you'd mentioned event space. I would. That's typically one you'll find on there. You might be able to find certain flex spaces. Yeah, you can do event space for. Certain areas probably won't let you. So it depends on the area specifically and what they want. But yeah, call the zoning and planning and find out there. If you're looking at it for your own purposes, you're going to buy a place and operate out of, then yeah, I would definitely check. And if you're looking to lease a space from a landlord, that landlord might be able to help you do some of that background legwork as well. But evaluating properties, so that's a good one. So what I typically look at when I'm evaluating a property, I want to look at, I'm just going to go to the next slide here just so you guys have that. If anybody has any other questions outside of this, there's my contact info. But when you're evaluating property, you're looking at it in a multitude of ways. So we're looking at $1 per square foot, right? We want to make sure that when we're buying a property, we're not overpaying for it, right? So if it costs $120 a square foot to build a brand new property, one of the metrics you want to look at is can you buy it below replacement cost, right? Because if you can build it for $120 and you go pay $150 a square foot for it, somebody else can come in behind you and build something to compete with you that's now going to make you obsolete potentially in the future. And unless you've got a really good tenant locked in there, sometimes that happens. Some people will buy above replacement cost because there's just a really, really good tenant, or it's in a really good location that's growing like crazy. And so we'll do that. But the dollar per square foot is something we always look at. So we want to look at what has sold and what is on market. So those are the two things. So we'll utilize services such as CoStar, and we'll dig back through here. So if you guys can see this, I'm going to zoom way in. Are you still seeing this?
Yep.
Okay. So you'll look at, we'll take a look, and we want to see what's going on from a dollar per square foot. This specific report, where are we at here? Let me find it. Leasing, rent, construction, sales. Here you go. Sales and market rate per square foot. So you'll see this is just one chart showing, Charlotte and the US, Charlotte compared to the US. So you'll see on a dollar per square foot, we'll look at those trends. We'll look at the trends of where's this heading, and on a dollar per square foot, are we in line with where the market is? If everywhere else in the market is at 100 and you've got something for 75, that's the similar type of property, you might have a good property on your hands. So we'll look at that, but we'll look at not only what's happened. So CoStar is looking backwards, and we'll look at all the properties that have sold and say, okay, on average, properties like this are selling at $100 a foot. You've got this one for 75 a foot. That's a good deal. We're looking at probably a good deal. We'll also look forward and say, okay, what's on market? If there's a bunch of stuff on market that's $110, $120 a foot, now it's starting to look like a really good deal, because it's like, okay, not only are we under what's already sold, the actual sale comps, but the on-market comps are even higher. Now it's looking like a really good deal. We'll do the exact same math on the leasing side of things. So we'll look up and see what's transacted in that area. Is it leasing at, if all of our leases are at $8 a foot, but we see 10 other buildings around that are leasing at $10 a foot that have already signed leases, now our comps for leases are at $10 a foot. If we're looking on market and everything that's being advertised is $11 or $12 a foot, again, we're getting the same good vibes. Hey, this is looking good. We've got a deal where we've got some upside here. However, if it's the reverse and you say, hey, look, I'm some of the market shows that these were at $10 a foot. We're right about that $10 mark, but everybody who's advertising right now is at $7 or $8 a foot. Something happened in that marketplace. What happened? Why is it now trending back downwards? And we're not seeing that too often in the industrial space, honestly, because things are just going crazy, especially around Charlotte. But those are the two big things we look at. We want to look at the dollar per square foot and compare it to the other properties. We also want to compare it to replacement cost. And then we want to look at those lease rates and make sure our lease rates are really dialed in. All right. So certain zoning, depending on the zoning, some listings have foot and vehicle traffic metric. Is there a resource a buyer or tenant can also look at to confirm these metrics? Also, can commercial tenant buyers take advantage of opportunity zones? So yeah, there are different foot traffic metrics websites you can look at. We use CoStar, which is an expensive site. I mean, if you're a commercial real estate broker or if you buy a ton of commercial property, CoStar is worth it. It's very expensive. So I don't really use anything but CoStar because we pay for it, and it stings to write that check every month. So I'm going to go there to get all my data. But yeah, there are different sites you can find to get vehicle and foot traffic metrics. Charles, I don't know if you know of any off the top of your head that you guys use.
Can't think of any free ones, but CoStar, Yarding Matrix, Axiometrics. I mean, those are all popular ones, but they're all costly ones too.
Yeah.
There probably are free ones, but none that I can think of offhand.
There's a group called Siteseer, SITESEER. I'm going to type it in the chat. And they, if you are doing any sort of retail, they've got a really good scenario where they'll pay. You can buy a report basically. It's like $150, I think, for a report. But let's say you're opening up a dentist office, you can say, hey, inside of this radius, can you show me where all the dentist offices are? Can you show me? I think they have some foot traffic metrics and things like that. And if you don't want to sign up for something where you're paying monthly, they might have some information for you as well that you can buy on a one-off basis. So, Let's see, how can commercial tenant buyers take advantage of opportunity zones? So yeah, opportunity zones are a great setup. So in an opportunity zone, the longer you hold the property, if you hold it for 10 years in an area and invest for 10 years, there's major tax advantages to opportunity zones to where you can essentially all but eliminate your taxes. I'm not a tax attorney, or an accountant, so chat with them about it, but you absolutely can as an investor. If you buy properties in an opportunity zone, there are tax incentives. Seem like they're changing daily, and depending on what administration is, how long those are going to last, you never know. But there's going to be, there are some pretty hefty tax advantages to buying in an opportunity zone if you hold long enough. And most of those have that stipulation where you have to hold that for so many years before you start to get that tax break. If you sell after 5 years, 7 years, or 10 years, I believe are the metrics. So yeah, definitely take a look at opportunity zones, and you can certainly take advantage of those from a buyer standpoint. Anybody else? Any other questions? All right, I'm going to stop my share here. So,
Well, Logan, thank you very much. Ladies, I'll turn it over to you to take us home for the evening.
Okay, well, if anyone has any other questions, now's your time, but put it in the chat or unmute and ask it. I will let you know that this recording is available only to attendees. And I'm only going to say this once, so please don't email and ask for it. If you want to access the recording, Ashley, you can just unmute. You don't need to raise your hand. To access the recording, you go to the calendar, you click on this meeting, and then you scroll down to the bottom of the page, and tomorrow the recording will be there at the bottom of the page if you care to watch it again. Ashley, did you want to say something?
Yeah, I just have a quick question. I don't know if it was already answered. But are there people like specialists that can tell you what exactly type of industrial building can be put on a lot or something like that?
yeah, so typically if you have a, just like the zoning and planning commission we talked about earlier, like they'll spell that out. So they might say, like, oftentimes what's happening now, industrial outdoor storage is a very big hot item specifically around Charlotte. But Charlotte is very, very picky about how you can do that and what you can and can't do. So they may specify, yes, you can put a warehouse on this space, but we don't want manufacturing, or yes, you can put a warehouse, we only want distribution, or it can be light manufacturing or light industrial. So you might be able to put a gymnast facility up in an industrial building. So that planning and zoning committee should be able to tell if you've got a specific concept, they should be able to point you in the right direction and tell you whether or not that's going to be an accepted use.
Okay, thank you.
All right, anyone else? Just unmute. You don't need to raise your hand.
I wanted to ask, is there a typical rule of thumb for the height of a building that you kind of look for? Like if it's at least this high that most people are looking for to rent?
That's a great question. It's going to depend on the tenant themselves. So in the distribution, new distribution, they're typically looking at those 30+ foot clear heights. Most buildings that are being built now are built at 32 and 36. Some of them are even 40. But that doesn't mean you can't find a whole lot of tenants at an 18 to 24 foot building. So it just depends. So, manufacturers, some of them don't need it, right? Some of them might need 16 foot and that's it. So might have,
Just to give you a heads up, your audio's cutting out.
5 foot tall, 30 foot tall. It says my internet connection's unstable. Give me 1 second.
Oh, you're back now.
I'm back. Okay, cool. So sorry if I cut in and out there, but the long story short of it depends. So there used to be a lot of really old buildings that were 12 to 14 foot clear heights. I would avoid those if you can, just because it's difficult to find tenants for those buildings. You can find them. And if you get the right number for that building, you certainly can make the math work, but you'll typically get much lower rents for those types of buildings. Those buildings that come in like the 16 to 24 foot clear height space, great buildings for contractors or for small manufacturing companies, light industrial stuff. You can fit, a lot of flex spaces fit that mold. You might be able to have a CrossFit gym in there, or you may have a gymnastics space, or you might have, any number of things that fit in that role. When you get into the distribution space, that's where you're really in like the 30s But I hope that answers your question.
Yes, I appreciate that.
Thank you so much, everyone, for being here. Thank you to Logan so much for sharing your knowledge. Thank you, Charles. This meeting always has such high quality speaker and it's so enjoyable and informational. We very, very much appreciate it. Anyone
you.
else have anything to wrap up? Les, you have anything?
No, thanks everybody for being here.
Can I ask one more question? So what,
Ashling,
what kind of incentives so for the industry investor can get from the government?
Well, most of the investment incentives that come along are on if you're looking at a tax incentive basis, we talked about the opportunity zones, those can be big incentives. Obviously, if you're doing a 1031, that's a huge incentive to 1031 exchange into it. As far as the government incentives, most of those go to the end user, and the government tends to, if you are an end user that's bringing jobs, that's where a lot of those government incentives are coming from. So the developers might be able to participate that a little bit, but a developer that's, let's say, building a building for or retrofitting a building for a manufacturer, most of the time, the manufacturer that's bringing that 200 jobs to that area, those are where the real government incentives are going to come in. So there are tax incentives for investing in areas, like we said, with opportunity zones, and if you're doing a 1031 or anything like that. But most of the government incentives are for the actual employers.
Hey, this is Antoine. I just wanted to see a question about, what's the due diligence period like for buying these properties? There's a lot of moving parts, especially, when you're trying to do something or rezone something. So I was just wondering how long or what's involved in the due diligence period.
Yeah, so typically what we're seeing is if the rezoning one's a different question. If you're trying to rezone, typically we will see that offer might be a scenario where you've got 90 days and then you can buy an extra 30-day due diligence, an extra 30 or maybe even longer than that. But most typical transactions, we're seeing somewhere between a 60, it will either be a 60-30 or a 90-30, meaning 60 days of due diligence and then 30 days after the close, or 90 days of due diligence, 30 days after the close. If it's a hot deal, sometimes they'll come in with a 30-30, or sometimes they'll just say, hey, cash, 45-day closing. But typically what we're seeing is that 60-30 model where buyers want to have at least that 60-day period to do the due diligence. And they're doing their property condition assessment, which is like your inspection. They're doing a phase 1 study, which is an environmental study on the building. You're still going to have to do your title search to make sure that you can get clean title of the building. Appraisals typically happen the same. So you're going to at least do those 4 surveys, typically right along with the title search. That's going to come along during that due diligence period. And then estoppels. If you don't do estoppels in your current business, asking for the tenants to basically sign to say, yep, I am leasing it. I know you've seen the lease and you've read through the lease, but I'm certifying that I actually have made all my payments. I'm certifying I actually do lease this space, and I'm basically certifying as a tenant that, yeah, that is me. I have signed that lease. So those are some typical things we typically see. And yeah, 60 to 90 days is not uncommon.
All right, awesome. I see that David Chuck did join us. Sorry, David, I didn't mean to leave you out. Thank you, David and Charles, for always putting on such a high quality subgroup and bringing us such great education and great speakers. We appreciate you very much, as well as we appreciate all of you for taking time out of your evening to be here. Thank you. And thank you once again, Logan. We hope you all have a wonderful evening.
good night, everybody.
Good night.
Night. Thank you.